Ever wondered why time and pattern recognition are of utmost importance in financial markets? Let's take a journey into the fascinating world of financial markets, where time and pattern recognition play pivotal roles. You see, financial markets are complex beasts, constantly shifting and changing. But amidst this chaos, patterns emerge, patterns that savvy traders can leverage to their advantage. This is where the time and PD arrays theory, or TAPDA, comes into play. TAPDA is not just another theory in the bustling financial markets, it's a unique perspective that combines the art of pattern recognition with the science of time. It's about finding patterns, yes, but it's also about understanding when these patterns are most likely to occur. In the realm of algorithmic trading, pattern recognition is a key strategy. Algorithms are coded to identify specific patterns, predicting market movements based on these recurring trends. But TAPDA takes it a step further, suggesting that it's not just the pattern that matters, but also the timing of these patterns. Now you might be wondering, why does the timing matter? Well, think about Killzones. These are periods of heightened market activity that coincide with market opens, closes, or news releases. They offer liquidity and volatility, both of which are favorable for traders. By emphasizing on the timing of PD arrays, TAPDA allows traders to anticipate these kill zones more effectively. Support and resistance, two fundamental principles in technical analysis, are also viewed through a fresh lens in TAPDA. The theory suggests that these psychological and collective behaviors of market participants are not only linked to price levels but are also time-bound. But let's not get ahead of ourselves. As intriguing as TAPDA may be, it's important to approach it with a healthy dose of skepticism. Financial markets are influenced by a multitude of factors, and isolating the effect of time-specific patterns might be challenging. The TAPDA theory is a new lens to look at financial markets, giving us a fresh perspective on how time and pattern recognition intersect. As we delve deeper into this fascinating theory, remember to keep an open mind, always questioning, always exploring, because that's what makes a successful trader. So, what exactly is the TAPDA theory, you may wonder? Well, imagine the financial market as a vast ocean. The price patterns are like waves, visible and tangible. These are the PD arrays, but there's more to the ocean than just the waves. There's a rhythm, a pulse that dictates when these waves rise and fall. That's the temporal aspect in TAPDA, the timing of these patterns. Now let's dive deeper into the TAPDA theory. It stands for Time and PD Arrays Theory. PD arrays, or pattern detection arrays, refer to specific patterns that the market forms. These patterns, like the waves in our ocean analogy, are not static. They move, they change, they interact with the market, and they do all these at specific times. The TAPDA theory suggests that these patterns, when they form and how they interact with the market, are crucial to understanding market behavior. It's not just about identifying the patterns, but recognizing when these patterns are likely to appear and how they may influence the market. For instance, consider a popular pattern, the head and shoulders. The pattern itself is important, yes, but according to TAPDA, it's equally vital to know when this pattern is likely to form, as this could indicate a potential market reversal. But how does one determine when a pattern might form? That's where the time aspect comes into play. The theory proposes that patterns are not random. They are tied to specific times, influenced by factors such as market opens, closes, and news releases. So the crux of TAPDA is not just about identifying patterns, but understanding the timing of these patterns. It's about knowing when to expect the waves to rise and fall in our vast ocean of financial markets. The TAPDA theory, in essence, emphasizes on the timing of pattern formation, suggesting that it's not just about what patterns form, but when they form. Have you heard about kill zones in trading? Just as the name suggests, the term kill zones carries a sense of excitement, and for good reason. In the world of trading, kill zones are periods of heightened activity, typically coinciding with market opens, market closes, or significant news releases. Picture this: the market is like a living, breathing entity, pulsating with activity. At certain times, this activity reaches a fever pitch, creating a kill zone. This is when the market roars to life with increased liquidity and volatility, making it a potentially favorable environment for traders. Now let's bring the TAPDA theory into the mix. This theory, with its emphasis on the temporal dimension of pattern formation, adds another layer of complexity to the concept of kill zones. Essentially, the TAPDA theory suggests that these zones aren't random. Instead, they're connected to the timing of pattern and duration arrays, or PD arrays. Imagine being able to anticipate these kill zones, not just by keeping an eye on the clock or the news, but by recognizing the patterns forming in the market. This is the potential edge that the TAPDA theory could offer. To further illustrate, let's think about a symphony orchestra. Each instrument plays a crucial role in creating the melody. Similarly, in trading, the PD arrays and the timing of their formation could be seen as the instruments, and the kill zones, the crescendos. They are the moments when all the elements come together to create a potentially profitable trading opportunity. Now, it's important to remember that trading, like any other form of investment, carries risks. While the TAPDA theory and the concept of kill zones can provide a fascinating perspective, they are not foolproof strategies. As always, it's essential to conduct your due diligence and consider a wide range of factors to make informed trading decisions. Keeping an eye on these kill zones could potentially enhance your trading strategy, as per the TAPDA theory. So, the next time you're studying market patterns, remember to keep an eye on the clock as well. After all, timing is everything. Let's delve deeper into the role of support and resistance in TAPDA. In the world of financial markets, the concept of support and resistance is as old as trading itself. These are price levels that markets struggle to break through, acting as invisible barriers on the price charts. The support level is a price point where buyers step in and resist further price drops. Conversely, the resistance level is where sellers swarm in and resist price hikes. But how does TAPDA add a twist to this age-old concept? It brings in the element of time. TAPDA views these levels not just as static lines on a chart, but as dynamic elements that interact with the market at specific times. It's a fresh perspective, offering a panoramic view of the market's rhythm. It posits that the psychological and collective behaviors of market participants are not just linked to price levels, but are also time-bound. This means that certain times might elicit stronger reactions at these support and resistance levels. It's like a dance between time and price, where the music's tempo guides the market's steps. Imagine a market approaching a known resistance level. Traditional technical analysis would have traders brace for a potential price reversal or breakout. But with TAPDA, traders also consider the time. Is the market approaching the resistance during a known kill zone? If so, the likelihood of a significant price movement could be higher. It's a fascinating concept that could potentially enhance a trader's toolkit. By considering the timing of pattern formation, traders could gain an additional layer of insight. They could anticipate market reactions at these levels with greater precision, adding an extra edge to their trading strategy. Of course, like any theoretical approach, TAPDA's time-based view of support and resistance needs careful testing and validation. But the potential it offers for a more nuanced understanding of market dynamics is undeniable. TAPDA introduces a new dimension to the classic concept of support and resistance, the dimension of time. What's the empirical evidence supporting TAPDA? Now, this is a question that might be lingering in the minds of many. The time and PD arrays theory, or TAPDA as we've been discussing, is certainly eye-catching in its innovative approach. But like any theory, it's crucial to scrutinize it with a discerning eye. TAPDA, as proposed, presents an intriguing blend of pattern recognition and market timing. However, one potential critique could be the lack of empirical evidence. The theory's basis on Twitter threads, while insightful, does not equate to rigorous scientific validation. Financial markets, in their inherent complexity, are influenced by a myriad of factors. To isolate the effect of time-specific patterns, as TAPDA suggests, would require a meticulous and thorough statistical analysis. The challenge here is not just to prove that these patterns exist, but also that they consistently interact with the market at specific times, influencing price actions. This is where the concept of kill zones comes into play. TAPDA's claim that traders can anticipate these periods of heightened market activity more effectively is a bold one. To substantiate this, we would need to see a pattern of successful predictions over a wide range of market conditions. Furthermore, the theory's approach to identifying support and resistance levels based on the timing of pattern formation is innovative but again, requires empirical validation. The implication that the psychological and collective behaviors of market participants are not just tied to price levels, but are also time-bound, is a significant departure from traditional technical analysis. So, while TAPDA presents a fresh perspective on trading, it's essential to approach it with due diligence. Any theory based on historical market data needs to be tested against various market conditions to assess its robustness and predictive power. After all, the financial markets are as unpredictable as they are complex. In the end, it's about asking the right questions, seeking answers, and never ceasing to learn. While TAPDA presents an innovative approach to trading, it's crucial to approach it with due diligence and rigorous testing.